quite expensive for a retiree to enter their required minimum distribution years with big IRA balances. Required minimum distributions, also known as RMDs, are a forced withdrawal from your IRAs and can cause your tax bill to rise significantly. The good news is, however, there's a lot you can do to minimize RMDs through things like Roth conversions. But as we're Roth converting, what is a good amount to leave as an IRA balance when you enter these RMD years? We're going to answer that question in today's video. Now, keep in mind, this video is meant for a general audience. The amount you should specifically be leaving in your IRAs is going to be dependent on your exact situation. But I'm going to give you a general answer in this video, and then also talk through how to find a more specific answer for yourself. First off, recently Congress changed the year in which you are mandated to begin these RMDs. So knowing whether you begin at age 73 or age 75 is going to be important in the discussion to follow. As mentioned in the intro, RMDs are a forced distribution from your IRAs. The government gave you a tax break when you contributed to these accounts, and so RMDs are in place to make sure the government has a way to claw back those tax dollars at some point in the future. In many retirement situations we look at, RMDs, if left unchecked, can force a retiree to take out far more income than they actually want. Well, in a progressive tax system where tax rates rise as your income rises, growing RMDs mean that you end up paying a lot more in taxes than you need to. And once RMDs begin, they're difficult to get in check. It's kind of like a runaway train, if you will. And so as we think about your situation, how do we find an acceptable IRA balance to leave entering those RMD years? What's an acceptable level of RMD that won't hurt your tax situation? In finding this answer, we need to have a reasonable estimate for what we expect our tax situation to look like when we reach said RMD age. The further you are away from RMDs, the more this is going to be an estimate rather than an exact science, because obviously a lot can change. On the screen, I have a 2026 tax graph for a retiree. Now, why am I using a 2026 tax graph in this analysis? Well, the Tax Cuts and Jobs Act is set to expire in 2026. With this expiring tax bill, we know the standard deduction is lowering and each tax bracket is rising by about 1 to 4%. Now, thinking about your retirement, what do we expect our tax situation to look like at age 73, for instance? Well, you will be on Social Security. You may even have a pension. We want to upload our expected guaranteed income into this tax analysis. By doing this, we'll find ourselves looking at a tax graph like this. Notice how the tax rates change when you are on Social Security. This is due to something called the Social Security tax torpedo that I've discussed in a few other videos. From here, we need to find an acceptable level of IRA income to have on top of our other guaranteed income streams. I've shaded the potential areas to identify what I believe is an acceptable zone or zones. We should almost always be comfortable filling up lower brackets, like the standard deduction where we're paying 0%, and the 10% bracket, which can change into the 18.5% bracket with the Social Security tax torpedo. This is why most retirees won't want to have a $0 IRA balance as they get into those RMD years. We should be comfortable showing income at these lower tax rates. From there, the yellow zones might be satisfactory based on your situation, and ultimately in most cases we want to avoid the red zones if we can do so prudently. The reason I want to go through this analysis is because I want to find an acceptable RMD amount and then essentially backwards engineer the IRA balance that would lead to that RMD amount. Now, there is no one-size-fits-all answer to this question. The right answer for your situation is going to fall somewhere on this spectrum. Let me explain the extremes of this spectrum, and then we'll move to the middle of the spectrum. There's a subset of retirees that will break the general rule and will want to convert all of their IRA balance. I recently recorded a video on this topic, and this is basically because they already have other income that will fill in some of those lower brackets. Now, there are about 3 situations that I find somebody might want to eliminate all of their IRA balance. Somebody with guaranteed income like a pension, retirees with big taxable accounts that force dividends and interest to their tax bill, and then wealthy retirees concerned with estate taxes, either federal or state. Here's a quick example why a retiree with guaranteed income might want to have a $0 IRA balance. We look at a similar tax graph to what we just showed, but now we're going to look at a $25,000 pension. We see that this pension fills up all of those lower brackets this person would otherwise want to fill with RMDs. Well, if we're able to convert all of their IRA balance at a tax rate less than 27.75%, it'd be quite prudent to do so. So again, this is someone who should consider emptying out their IRA balance. On the other side of the spectrum, we have someone who might be forced to leave a larger IRA balance. They might not have enough control or time to convert down to a specific, more acceptable balance. This is generally the case for someone who needs to Roth convert, but again, doesn't have enough time to minimize their RMDs or would be forced to pay too high of rates to minimize. Remember that Roth conversions are a sweet spot calculation. They only make sense if we're converting at rates less than we will see in the future. On the screen, I have a graph showing the top tax bracket a specific retiree would be estimated to experience. The yellow bars are going to be their default situation, assuming they didn't do anything like Roth conversions, and the blue bars are a Roth conversion situation. If this retiree does nothing, RMDs will push them into being taxed at 33% and 35%. So these are very expensive RMDs, pushing them into higher and higher tax brackets. But if we begin converting in the 24% bracket, we see we mostly maintain the 24 and 28% brackets for their retirement. Now, do we want to be paying 28% on a good portion of their RMD? Well, obviously no, but there isn't a way that this retiree can convert more prudently. So they are forced to leave a larger IRA balance and simply deal with some of those higher brackets and other penalties. Another situation where someone might want to leave a larger IRA balance is if they're planning on doing some charitable giving throughout their life. QCDs, or otherwise known as qualified charitable distributions, are one of the best ways to give to charity because there's something called an above-the-line deduction. If you have a $50,000 RMD, you can give that directly to a charity and completely eliminate that RMD from your tax bill without having to itemize deductions. And so if you plan to give a bunch to charity throughout your life, you certainly shouldn't get overly aggressive converting, because why would you want to give converted tax-free dollars to charity? Instead, you want to give the highest tax dollars to charity to eliminate them from your tax bill. And so again, going back to the spectrum of answers, people in the extremes will not want to follow the general advice that follows here. So let's say you're not in one of the extremes and you find yourself in this middle zone, in the middle of the spectrum. How much IRA balance should you leave to those RMD years? Well, let's go back to the tax graph and look at a married filer situation. I've added in some dividend income in here just to show how a tax graph can change as we think about common income streams alongside Social Security. Now, I apologize ahead of time for not explaining all the reasons the tax graph looks the way it does. For the sake of time, we're just going to brush over this and just take the tax graph at face value. We have an ideal RMD amount range in green and a satisfactory RMD range here in yellow. The green range ends at about $25,000. The yellow ends at about $60,000 of RMD income. Now, one thing to keep in mind as you consider the acceptable RMD amount is that RMDs creep over time in most cases. This is the case for two reasons. First, the starting withdrawal rate you are forced to take is small enough where most portfolios will grow beyond the withdrawal. Meaning if you have $1 million going into RMD years and all you take is the RMD, you'd expect that $1 million balance to grow for some time, thus also growing RMDs. Now, what stops this IRA balance growth is basically the second idea that leads to RMD creep. And that is you are forced to take out more and more each year. So eventually you're forced to take out a high enough RMD withdrawal rate that your IRA balance can't grow beyond that withdrawal rate. And so these two variables intersecting essentially lead to a growing RMD as we move through time and will typically grow until your late 80s. So we have to factor in this growth as we're answering this larger question. So let's move to the final part of this estimate. If we use, let's say, $25,000 as an acceptable RMD for this married couple, then we can pretty simply use the RMD withdrawal rate table and estimate an acceptable IRA balance. If your RMD age is 75, that would lead to about a $615,000 balance, and that would give you about a $25,000 RMD. As we factor in RMD creep, we'll find that an acceptable IRA balance is going to fall into a range of $400,000 all the way up to about $750,000. Now, obviously, I'm rounding for simplicity purposes. This leaves enough room for RMD growth, but still attempts to keep that IRA balance under control. Now, it's worth noting that this calculation was made using 2026 graphs. So let's say the year you begin RMDs won't be 2026, but rather some year in the future. We would still want to adjust this range by an inflation target. So let's say RMDs are set to begin in 2034, 8 years from 2026. At a 3% inflation target, we would expect this range to be 25 to 26% higher to factor in inflation adjustments within the tax tables. Again, this is just an estimate. Then just for your data and calculations, in a previous video I laid out the table on the screen. It estimates RMD growth based on historical asset assumptions and a Monte Carlo analysis. This table is inflation adjusted, and you'll see 3 columns based on the allocation within your IRA. So let's say you're using a classic 60-40 portfolio in your IRA, and RMDs for your situation start at 72. In inflation adjusted terms, you would expect the RMD you are forced to take at age 80 to be about 50% higher than your starting RMD due to this RMD creep effect, again in inflation adjusted terms. So as you're thinking about an acceptable IRA balance to leave during those RMD years, make sure you're considering this table and the RMD growth that we've talked about. Now, I hope you found this video highly informative as you consider your tax strategy in retirement. As you can see, tax planning can be somewhat complex. What if you mess up and you leave too big of an IRA balance going into those RMD years? Does this mean your tax situation is completely ruined? No. Know that you have some options to do some Roth converting even after RMDs begin. It's not as if you reach RMD age and now conversions are off the table. But you need to be very careful on converting while on RMDs. Click here to watch a video explaining how to convert prudently when you're taking those RMDs. Thanks so much for watching, and always remember, you don't need more money, you need a better plan. We'll see you in the next video.